Worked out. No,
Do you remember where you were on December 31st, 1999, at the turn of the year 2000? I remember it well. I was in New York. I went to see the fireworks near Liberty Island behind the Statue of Liberty. Then I spent the longest night of my life trying to get back home. The year, the century, and the millennium began with an 8-kilometer trek to reach a train station. As I walked, I gazed at the lights of the business district just ahead, a symbol of America's financial success. Behind one of the towers lay the headquarters of the bank I worked for at the time. I noticed some lights were still on. We were just a few months away from a major economic crisis, and despite my position in finance, I had no inkling. I just thought my feet hurt. Stock indices were at their all-time highs, the economy fueled by the digital revolution, investor enthusiasm for new technologies, and a relative peace in the world inspired fabulous optimism at the dawn of the second millennium. Believe it or not, when I learned about the bankruptcy of energy giants like Enron a few weeks before the following Christmas, I reflected on that New Year's Eve when I, like everyone else, still believed in a wonderful future. If only I had known what was to come. But in this story, I wasn't the only one. 8 years later, the same mistake. I didn't even know about the existence of subprimes. What's barely about me is that once again, I wasn't the only one who didn't see it coming. There were indeed a few individuals who knew what would happen. They made headlines during those crises when they tried to warn the financial world. In 2020, another, less publicized figure gave a long and fascinating interview to the Swiss newspaper Neue Zürcher Zeitung, or the New Gazette of Requies. His name is Russell Napier. He's an economist, writer, financial strategist, and market historian, a specialist in this kind of foresight. He foresaw not only the two major crises of this dark new millennium, but also the one before, like the Asian crisis in 1997, and even more strongly, the one we're going through now. That day, he informed the journalist in great detail about everything happening at the moment, including what seems inexplicable to us: inflation and rising rates, stock market euphoria, inverted yield curves, yet delayed recession, decreasing liquidity without impacting the value of risky assets. Russell explains it all, and what particularly interests us is that he also knows how all of this will evolve over the next 15 years. Believe me, what he predicts is significant. Who is Russell Napier? That's what I wondered when I first heard of him, and also why I hadn't heard of him sooner. But well, behind that red beard is an expert among the most impressive in modern economics. Russell was born in Australia. He's in his vigorous 50s and has been hyperactive in finance for 30 years. He's not an investor. He's an economic strategist with an extraordinary mind. He observes and analyzes macroeconomic events, comparing them to history to draw conclusions published in the form of books, paid newsletters for institutions, or articles in highly specialized publications when he's not being interviewed himself. That's how he earns his living. He also teaches financial markets at the Edinburgh Business School, but he's primarily a history enthusiast, particularly financial history. That's what made him a phenomenon. Give Russell any date, and he'll tell you what the price of oil was, the euro-dollar parity, who was at war, who was in crisis, who presided over the European Union, and where interest rates, the Dow Jones, and nickel prices stood. With such knowledge, it's no wonder that knowledge and foresight can be confused. Russell regrets that most of our current economists have been trained in only one form of economics, market economics. Without specific training in financial history, our current brains know nothing else. Neither wartime economics nor directed, planned, or mixed economies. Their understanding of major economic mechanisms is thus very incomplete. For him, market history is the best guide to understand the future, and it's precisely his expertise in this area that makes Russell a very powerful seer, and there's nothing magical about it. In 1997, he worked for Credit Lyonnais Securities, stationed in Hong Kong, experiencing the Asian crisis from within. This allowed him to subsequently recount it in The Asian Financial Crisis, Anatomy for an Asia Resilient, his first book published in 1999. Napier already identified the over-indebtedness and foreign currency dependence of rapidly growing Asian countries, claiming massive capital inflows. He also identified the real estate bubble and excessive speculation that brought the Asian banking system to the brink amidst rapid devaluation of local currencies. But what's most important in this story is that this first crisis was a revelation for him. The crisis, that's what will occupy the majority of his thoughts from now on. 5 years later, while the world digested the abrupt explosion of the tech bubble, Russell decided to write another book, Anatomy of the Bear. He revisited the 4 major periods in our history during which the economy experienced significant disruptions to better anticipate the next ones. He revisited the interwar crisis in 1921, followed by the Great Depression after the 1929 crash, then studied the situation in 1949 during Europe's Reconstruction, and finally, the American crisis of 1982. Thanks to his work, he gained encyclopedic knowledge and a complete understanding of economic and financial events. He managed to identify patterns, cause and effect relationships, decisions that always lead to the same consequences. That's why he can explain everything happening right now. I mean everything, despite all the inconsistencies we're witnessing. So, crisis or no crisis? Well, this time, many voices are warning of an imminent major crisis. All the signals are there, starting with inflation, forcing central banks to deploy the interest rate weapon. Yet stock markets are all on the rise, and nothing seems to disturb them, not even the press conferences of Jerome Powell and Christine Lagarde, or the inverted yield curve, a harbinger of recession, at least theoretically, since aside from Europe, this recession is still pending. Historically, whenever short-term yields have exceeded 10-year yields, a recession has followed within a maximum of 18 months. It's happened 6 times in the US, and this time the curve inverted in October 2022, so it's been a year. Yet still nothing's moving. So where is this wave of bankruptcies, this surge of unemployment and misery, this burst of stock market bubbles that the doomsayers have been promising for months? Russell has an explanation. Nothing's moving because only 5 people realize we've shifted into a different universe when the economy transitioned into another dimension. The COVID crisis changed much more than we imagine. It didn't just alter our daily lives, disrupt our work habits, or change our perspective on life. It ended an economic era that began 40 years ago, the market economy in OECD countries, and essentially since the end of World War II, with a few exceptions. The economy was based on supply and demand, where companies and consumers decided what they wanted to produce or buy without government intervention, and prices were determined by what people were willing to pay and what sellers wanted to earn. In simple terms, markets allocated resources based on demand. Of course, there was marketing that sometimes pushed consumption of things we didn't necessarily need, but well, that's a detail. Universities taught the theory of market efficiency, demonstrating that markets tend to balance themselves without any state intervention. They also taught that a market economy stimulated competition, competition spurred progress, and progress boosted profits. From this market economy stemmed the liberalism in which we've all been immersed since birth. Liberalism is somewhat like saying every man for himself, but with common rules and a singular goal, growth. However, this doesn't mean that the state has no role to play. Monetary stability is entrusted to independent central banks that must also ensure labor market dynamism. Finally, since the 1980s, private banks have been printing money, fueling the economy through credit. This is all familiar. Most economies worldwide have this face, especially in the US or Europe for nearly 40 years. But Russell Napier likes to remind us that it hasn't always been this way and won't remain so. With the health crisis, the market economy has reached its limit, and we've entered the era of directed economy. Remember, it's the end of 2020, and the world received such a violent shock that governments had to deploy massive measures to support their economies and prevent cascades of bankruptcies. The first effect, hundreds of billions of dollars suddenly flooded the markets through government aid in cash and the establishment of state-guaranteed loans distributed by commercial banks. All of this boosted price indices. These measures were supposed to be temporary, driven by urgency. But emergencies stack up, and government guarantees become like a free money fountain. There's no need to increase debt or collect more taxes. Just provide guarantees to commercial banks to lend to economic agents without spending a dollar. This is how governments regain control over money creation, right under the nose of central banks. But there's more. State-guaranteed loans quickly became powerful political tools to direct the economy by choosing which sectors or activities or types of favored companies to support. The concerned governments have definitively ended the market economy. Russell calls this phenomenon the politicization of credit. He quickly assesses that 40% of outstanding credits in Germany are guaranteed by the state. In France, it's 70%, and in Italy or Japan, it's 100% because every loan that recently matured was financed through another state-guaranteed loan. By regaining control over credit, governments aim to control growth and inflation. So according to Russell, we've just shifted from a market economy to a directed economy. And this explains all the inconsistencies we're witnessing at the moment. In such a model, the government plays a significant role, not limited to market regulation or surveillance. It controls the flow of capital and chooses which sectors to promote. History shows that this is a dangerous situation. In 1950, the dirigist British government directed available capital towards coal mining, automobile production, and the supersonic aircraft project, Concorde. None of these industries had a future. Central banks thus face an incredibly complex game. They must maintain monetary stability and thus curb demand, while governments deploy an arsenal of purchasing power aid or investment, which leads to the opposite effect and sustains inflation. With record debt levels in major OECD countries, maintaining high inflation serves an interest. It devalues the currency and the value of debt issued in that currency. It also fosters growth as it's an integral part of GDP. Why is this shift happening now? According to Russell, the market economy model has run its course. When the debt's growth trajectory, be it sovereign or private, surpasses that of economic growth, as is the case in the US, UK, France, or Japan since 2020, developed economies based on the Anglo-Saxon model of infinite money find themselves over-indebted and on the brink of chaos with every normal or necessary correction or recession that comes along. Each requires more effort than the previous to avoid a catastrophe. It's this record level of indebtedness pushing the economy to start its transition and governments to reclaim their monetary policy, even if it seems paradoxical in the case of the European Union or economies functioning with a common currency. Thankfully, even in an authoritarian economy, government borrowing possibilities are limited by the counterparty. In theory, to borrow from markets, you need lenders. If things go awry, there will come a time when no one wants any government's debt because its debt level will have become too high, or other threats will loom over its solvency, threats like war, an energy crisis, or a recession. This is what normally happens in a market economy, but it's over. We've turned a corner, and with the directed economy comes financial repression. Behind this ominous name lie practices already in existence, historically frequently used, which will become a norm, even the pillars of future economic policies. What does it involve? For the plan to work, states need a base of national investors trapped by regulations imposing the purchase of government bonds regardless of their yield. Over half of the U.S. government's debt is held by Americans, mostly by institutions, insurers, fund managers, and by the American Central Bank, which holds a quarter of the debt. In the future, more may be required. On the one hand, the government may legislate to compel new investors to buy state debt whenever needed. On the other hand, it will maintain inflation at a high level of 4 to 6% per year, despite central bank interventions, to devalue debt that will never be repaid. This is what's called financial repression. Some prefer to call it financial requisition. It's in place in China, and Japan is diving into it. Our parents or grandparents experienced this in the US and even in Europe just after the war, and it's happening again, first here, then in France, when the dollar definitively loses its status as the #1 reserve currency in the world. So now that we know what's happening, what do? Russell obviously advises avoiding the government bond sector for the next 15 years. According to him, despite the yields, holders of sovereign bonds will be the first to be deprived since everything will be done to erode their nominal value through high inflation. However, on the equity side, there are excellent opportunities in sectors providing answers to current government issues: energy, ecological transition, food, and any industry that helps break away from dependence on Chinese products. Companies operating in these sectors should benefit from significant state support and promise long-term success. So be selective and aim for promising sectors. Lastly, Russell gives one last piece of advice. Remember that financial repression will inevitably lead to frequent changes in regulations on international markets. Be cautious because capital may end up controlled, as is already the case in China, and to a lesser extent in the US, or it may be locked. Invest instead in a country where you plan to spend your retirement. It's a matter of choice. We've reached the end. Don't forget to subscribe to Sphinx Sky, like, comment, and share the video to broaden horizons.